with our marathon part 2. Okay, so here comes the first question. That means on the basis of the information given below, this is a question from depreciation which covers a good part of depreciation. How do we cover this particular question? Let's look at it in a proper way. The question says that on the basis of the information given below, answer the following questions. The balance of the accumulated provision of depreciation account at the beginning of the year was 2 lakh rupees when the original cost of the asset was 10 lakh. The company's charges full 10% depreciation on SLM method on the basis of for all the assets including those which have been either purchased or sold during the year. One such asset costing 5 lakh with accumulated depreciation of 1 lakh was disposed of during the year. In this particular question, we are not only covering the topic of the SLM method but also provision for depreciation. Okay, let's talk about this. In terms of SLM, how do we calculate this particular question? In this question, we are given that there is a balance of 10 lakh as per the machinery that we have, right? The machine or the asset we are talking about, we have around 10 lakh rupees in that particular asset. Now the point is we have an accumulated depreciation. Now the accumulated depreciation in that case is of rupees 2 lakh. So if I say that the value of the asset is 10 lakh and 2 lakh has been charged as depreciation from that, then means we are left with 8 lakh rupees in our pockets. Now this 8 lakh rupees is what? This 8 lakh rupees is the the written down value method, that actually the book value. It is actually the book value of that particular asset currently. Now when we have this particular amount in our hands, then what next do we have? Out of this 10 lakh rupees, we have given away 5 lakh worth rupees of book value. The face value was 5 lakh and the depreciation on it was 1 lakh. So what is it they are asking? They are asking the depreciation for the current year. What would be the depreciation for the current year? How do we calculate it? See, one such asset costing 5 lakh with accumulated depreciation as at the beginning of the year was disposed of during the year. Now the point is during the year we have sold one particular asset. The value of the asset was rupees 10 lakh, right? Out of this 10 lakh, which was the accumulated rate of depreciation was 2 lakh. That means till now, if we talk about the life of this asset, the life of this asset was basically we are charging it at 10%. Life is not required. We know depreciation every year to be charged is 1 lakh, right? So if we are supposed to pay a depreciation of 1 lakh on this, then what are we going to do for this year? We are assuming, see, in this question, if I assume that it was disposed of, let's say, at the end of the year. I'm giving it that way. I'm just changing the question. It says at the end of year. So if it is sold out at the end of the year, then the entire question says that, see, the value of the asset overall was 1 lakh, na? Was 10 lakh. Even if we put depreciation on it, SLM method is basically called original cost method. Why is it called original cost method? Because the value of the asset remains the same. The straight line method, the depreciation to be charged every year remains same. It doesn't change at all. That means the value of the asset for considering the depreciation is still 10 lakh and we'll calculate 10% of 10 lakh. So depreciation would be 1 lakh for that particular year. So we are taking it as depreciation for the current year is 1 lakh. Ideally, they are supposed to give you whenever you are selling a particular asset. If you would have sold this particular asset in the beginning of the year, then what would have happened? Let's talk about that as well. If the value of the asset is 10 lakh, right? Then the depreciation till now is of rupees 2 lakh. So now we are selling an asset worth rupees 5 lakh. The depreciation charged on it is rupees 1 lakh. Right? So this is getting disposed of. So technically out of the total asset of 10 lakh, 5 lakh is being sold at 1 lakh depreciation being charged on it, while the remaining 5 lakh is here and the depreciation on it is 1 lakh rupees. So one part is sold, this part is sold, and this part is still carried forward towards the business. So depreciation would be continued on this, while this provision will be gone. Remember that the accumulated depreciation is more or less like A soul. It's like a soul, and the machinery is the body. If the machinery or that asset is sold, the depreciation according on that particular scenario also gets away. So basically it would be 5 lakh minus 1 lakh. The value would be 4 lakhs. Right? So this would be the value. Oh, I think let me just show it in a better way. I hope it's visible now. It's basically 10 lakh and divided into 5 lakh and 5 lakh. One part is sold, one part is carried forward, right? So the part which is carried forward, now whatever part is left, this is the book value of the part that is still left with us. Now if I want to charge depreciation on the left out value, it would be 50,000, because 10% of 5 lakh would be 50,000. So that is why the value is going to change. Right? Okay. Now comes the next question. This was D 1 lakh. The balance of the accumulated depreciation account at the end of the year, considering the current year depreciation charge, would be. Now the point is, the question is clearly saying that if we charge a depreciation of 1 lakh this year, then what is going to happen? If I have, see, the value of the asset was, okay, the value of the asset was overall 10 lakhs, right? The asset which was sold was 5 lakhs, and the one which is continued in the business is again 5 lakh. Then, okay, now this 1 lakh worth rupees asset is gone. Now this asset is gone. What are we left with? 5 lakh rupees of balance. From this 5 lakh, we would charge 1 lakh, which was already charged. Technically, the total asset was of 10 lakh and 2 lakh was its accumulated depreciation. The one which is sold already, the depreciation charged on it is also gone with it. If the body goes, the soul also goes. Na? So it's basically like that only. If the soul is going, then the value of that particular asset is also going away. So this is going all together. Now what are we left with? We are left with 5 lakh rupees of the asset which is still continuing in the business. Then 1 lakh rupees of depreciation is charged on it, and now 10% of it would still continue. That means if I have to take the depreciation, it would be 1,50,000 in this particular year, right? So depreciation would be 1,50,000 that is going to continue in our business. So that's the next question. Okay. Here comes the next question, everyone. For any of the suspicious transactions, when we talk about it, for the purpose of suspicious transaction reports, the suspicious transactions are means a transaction whether or not made in cash to a person acting in good faith, and dash gives a rise to reasonable ground of suspicion to it. Then we have appears to be made in circumstance of unusual or unjustified complexity, or appears to have no economic rationale or bona fide purpose. What is the particular the transaction which would be treated as an STR? Okay, so when we talk about the question, the correct answer is D. That is, all of these are correct. And normally, any suspicious transaction reporting is done in terms of FIU, that is Financial Intelligence Unit. A question can also be asked regarding this Financial Intelligence Unit. Ideally, within 3 days, we are supposed to tell them that there is some suspicious transaction which has been incurred, and that can be detrimental for the bank or the economy altogether. The correct answer is D. All of these are correct. They are all covered under the definition of STU. Okay, this was asked in the previous year examination, so that is another question. And at the same time, let me tell you one more thing. When we talk about the reverse mortgage loan, when you're looking forward to this particular question clearly states that whatever new changes are incurred in terms of the banking area, any new scheme is being introduced, or any changes that are made in the banking side towards providing of the loans, they are asking questions about it. For example, Bheem UPI questions has been asked on Bheem UPI, they can definitely go ahead and ask you questions regarding Bheem. They have asked about Bheem, then they can ask you about RTGS or NEFTs, then they can also ask you about the limits, then they can ask you about the time period in which they would be conducted, then they can also ask you about the various schemes in terms of education loans, priority sector loans, are there any relaxations to given to it. So these kind of questions can be asked. This question that I'm discussing is basically a question that has been asked in the previous year examinations. So let's discuss through this as well. It says the reverse mortgage loan or RML scheme, though apparently enables senior regular income by pledging home with the lending bank, and the product has not met with much success due to the obvious reasons such as non-availability of regular income beyond tenure, leading to an uncertainty as to how to manage the payment without payment after the loan term or quantum. To overcome the weakness of the scheme, they introduced an improved reverse mortgage loan enabled annuity scheme has evolved as significant improvement over the initial RML product variant. So this is a question on RML. Basically, this was introduced for the senior citizens of our country where their children refuse to take care of them. So this particular scheme was introduced where they will pledge the immovable property to the bank, and the bank will give them proper monetary aid for whatever period they are living. Till the time many of them is still there, the bank will continue giving them money, and after their death, then the person who is going to take over that property, he is supposed to pay back that amount to the bank if they want to take that property. So this was basically introduced for all the senior citizens who were not getting some kind of incomes or aid from their own children. Right, so this was a very good initiative, but somehow it didn't get that much of popularity. But later on, they have introduced RMLEA, that is Enabled Annuity Scheme. So on the basis of this question was asked, RMLEA scheme has been promoted by NHB or the HDFC Bank or the Central Bank of India or Star Union Dai-ichi Life Insurance Company Limited. Okay, so when we talk about RMLEA, the organizations which have promoted is third and fourth, that is Central Bank of India and Star Union Dai-ichi Life Insurance. These organizations, that means B is the answer. These organizations have promoted, see, the answer is B. These organizations have promoted the RMLEA. It's always better that you go through the FAQs which are there on the website of RBI, as well as these basic schemes and all, so that you know what is the crux. You don't have to read the details, but just out of that entire area, just give a crux of it. Just go through the basic pointers regarding what are the limits, is there any margin, then what are the charges, if there is any specific condition. Go through it properly so that you don't make a mistake in the examination at all, right? You don't have to guess it up then. Okay, now this comes the next question. Which of the following features are true in respect of RMLEA? Married couples will be eligible as joint owner borrowers for the financial assistance. Then joint borrowers will have the option to receive the annuity, and in their respective individual names on proportionate basis that may decide. And then is the senior citizen borrower are eligible to receive assured lifetime payments even after the completion of the fixed term with increased quantum of the annuity. And the last one, the fourth one, is the period annuity payments are subjected to income tax and taxable in the hands of the annuity recipient. So among this, what would be one of the basics information regarding this point, right? That is regarding RMLEA. So the correct answer here is 1, 3rd as well as the 4th is correct. Rest everything is not correct. There are only 3 points that are correct. The third one isn't. That the senior is eligible to receive a payment, a short lifetime payments even after completion of the fixed term with increased quantum of annuity. So this is the only area which is not there. Rest everything is there. So that, oh sorry, it is there as well. I think I'm making the mistake that the point is this one. The joint borrower will have the option to receive. So the second one is not there. It is 1/3 as well as the fourth one. The correct answer is A. That is 1/3 and 4th. Married couples are eligible in terms of borrowing, and their senior citizens can increase till the time they are surviving. These people will receive money, and at the same time, periodic payments are subject to income tax and taxable in the hands of the annuity recipient, right? So these people are a part of it. Just the senior citizen borrower are eligible to receive a short life is also there. See, this is also there. 1, 3 and 4 is there. Joint borrower will have the option to receive annuity separately. That is not there. They won't receive it in their names and in their names or on any proportionate basis. This point of thing is not there. Right? So 1/3 and 4th are correct. This is 4th. This is 4th. Okay, here comes the next question. As I told you, there can be questions regarding the loan to value system. So when they say the loan to value in case of a senior citizen bracket of 70 to 80, as per the scheme is, under the scheme, the senior citizens are going to get a loan to value. That means the loan which is based upon the value. It's going to be 50%, 75%, 70 or 60%. What would be the value? It would be 70%. Right? So it would be 70%. Now, under the reverse mortgage enabled annuity, which of the following are considered as primary annuity sourcing institution? The scheduled commercial banks, the housing finance banks, or the life insurance corporation, or all of the above? As such, which is the primary annuity source is life insurance corporation, that is LIC. LIC is the primary annuity source institution, right? So it's C. Okay, here comes the next question, everyone. How much an ordinary annuity of 650 per year worth in 8 years at an annual interest of 6%? Okay, so let's look forward to this question. How much ordinary annuity? See, the ordinary annuity is there. Ordinary annuity means annuity which is done at the end of the year. Always remember this term. Ordinary means the annuity which is there in terms of see, what would an ordinary man do? He'll always delay his payments. He'll say, Pakka, I'll do it by the end of this year. I'm not going to do it in the beginning of the year. Till the time we don't feel the deadline, we don't do the work now. So it's based upon that. How much will an ordinary annuity of 650 per year be worth in 8 years? What would be the future value of it? So we're looking forward towards the future value. So how can we calculate it? We can calculate it on the basis of the this formula, that is P1 plus R raised to power n minus 1 divided by R. Now, okay, this is the formula for ordinary annuity. If you remember this formula is helpful in finding the formula for annuity due as well. The difference between ordinary annuity and annuity due is ordinary annuity is done if this is year 1, this is year 2, this is year 3. See, what is annuity? Annuity means something which is continued on a repetitive basis. It is done on repetition basis. So in the first year, you don't put it in the beginning of the first year, you put it at the end. So if you're putting it at the end, then you will receive in the second year. Then whatever interest you'll receive, you'll add more, then you'll add more principal to it. The also already there, then you will get more interest. Then this is how we're going to continue. For the first year, you will not receive anything, considering you are putting money into it on the 31st of March. That means by the end of the year. When we talk about annuity due, you will put the money from the very beginning. You're putting it in the beginning of the year. So when you're doing it in the beginning of the year, then what would you do? It would be P 1 plus R raised to power n minus 1 divided by R. But since you are doing it by the beginning of the year, you're doing it in the beginning only. So you will get an additional interest of 1 plus R. This is the point that I was talking about, that you receive more money. That is in terms of one more year of interest is received, right? That is what we do in terms of annuity due. So in one particular question, I've explained both the points, that is regarding annuity due as well as the ordinary annuity. Now let's find out the answer, that is P 1 plus R raised to power n minus 1 divided by R. It is going to be the ordinary annuity is basically 650 rupees per year. Then it is 1 plus 6% raised to power 8 minus 1 divided by, the rate was 6% now, so it is going to be 0.06. Now calculate the question and find the answer. This will help you to find the correct value. When you are trying to find 1 plus 6% raised to power 8, what you can do is you can do it with the calculator in a better manner. So let's understand this particular topic using the calculator too. Okay, so in this case, what you can do is, let me show it to you using a calculator there. Okay, so how can we deal with this particular point? It is 1 plus 6% now. So I'm typing 1. It says 1. Okay, I hope it's visible now, right? It's 1, then we have plus, then we have 6%, right? So it is 1 plus 6%. We have added it up. Now the point is, it's not about the 1 plus 6%. It's more about raised to power 8. How do we calculate raised to power 8 in a quicker manner? So what you can do is, once you have this 1.06, now click on multiply, everyone. Click on multiply and then click on equal to 7 times. You don't have to do it time and again. All you need to do is click on equal to 7 times. That is 1, 2, 3, 4, 5, 6, 7. Right? So this will give you 1 plus 6% raised to power 8. So what you can do is, one of the ways to calculate it, I'm writing it here only. How do we calculate it? It is basically, if we have to find anything raised to power a particular power, how do we deal with it? We'll click on multiply once, that is 1.06. I clicked on multiply once and I clicked on equal to 1 less than the power required. That is, I'll click on it 7 times. Rather than 8 times, I'll click on it 7 times. To find the square, how do we find the square? That is 2 multiplied by 2 is 4. Now, I can do the same point. I'm just showing it to you through this particular calculation as well. So if it is like this, right? Okay, look at this now. This is the area. If I am clicking on 2, then I'm clicking on multiply, then I'm clicking on here equal to. It becomes 4. Now I am clicking on it again, it becomes 8. Now I am clicking on it, it becomes 16. Then 32. Then 64. Isn't it changing on its own? This is basically, we have given this particular thing to the calculator, that they have to calculate that particular value. Square, cube, then 3 times and 4 times, all by using multiply only once and dividing, then clicking on equal to time and again. Now that calculation is automatically done. So this is how you can use your calculations. In case you haven't tried this, then go ahead and try it out and choose your calculator wisely and practice on it as well, right? So using this particular method, you will get the answer. The correct answer that you will get here is that is 6433. So the correct answer would be D. That is 6433.38. Right? It's 6433.38. Okay, here comes the next question. What would you pay for an ordinary annuity of 2000 paid every 6 months for 12 years if you could invest your money elsewhere at a nominal rate of interest for 10% compounded semi-annually? So how do we find this one? Okay. The question says, what would you pay for an ordinary annuity of 2000? You are putting 2000 every year, paid every 6 months for 12 years. If you could invest your money elsewhere at a nominal rate of interest of 10%. See, in terms of 10% semi-annually, this is your rate of interest that is given to you, right? So what you can do is you can use it in that way only. You have got your principal, you have got 1 plus your rate, you have got raised to power 12 minus 1, whatever your value is, now dividing it by r again. So it is going to be, the principal is rupees 2000, 1 plus your rate is 10%, but this is compounded semi-annually, right? So if it is semi-annually, then what are we going to do? It would be, it is semi-annual, so we will not take it at 10%, we'll take it at 5%. We'll take this value at 5% and raised to power 12 minus 1. Then whatever your value we have in terms of this, we'll have 0.05. Okay, now there is one more point. Every 6 months for 12 years. If it is for 12 years, then we'll have to multiply it by 2. So this would be 24 times rather than 12 times. It is 24 times because it is compounded semi-annually. That means for 12 years we'll be compounding it twice in year. So it is going to be 24 times, right? So in this case, the correct answer would come out to be 27,597. In this case, all you need to do is you can click on 1.1 plus 5% on your calculator. You will get 1.05. Okay, I'm sorry. So now let's continue there. So when we are trying to find it, all you need to do is 1.05. Once you have got 1.05, then what you need to do is, it would be 1.05, click on multiply and click on equal to 23 times. This is what you can do on your calculator. This is the trick I've written you, how to calculate this question using your calculators, right? So correct answer would be 27,597.20. Okay, now comes the next question, everyone. The KYC is required to be done at least in every dash for high risk customers. See, there are three kind of customers that we can say. One is low risk customers, then medium risk, and then we have high risk, right? So all these risks are there. So for low risk customers, it is 2 years. For low risk customers, it's 2 years. For medium, it is 8 years. And for high risk, oh, it's actually the opposite. It's actually the opposite. For low risk customers, it's 10 years. Then for medium, it is 8, and for high, it's 2 years. I learned it in the way of 2, 8, 10, right? So this is high, then medium, and low risk. So KYC or know your customer is required to be done at least in every. They're looking forward to high risk customers. It is 2 years. So in one particular question, we are dealing with all the three types. That is 2 years, right? Okay, here comes the next question, everyone. Maximum monthly withdrawal limit of small saving account is. These kind of questions, checking the various limits, whether you know about those limits or not, can be asked in the examination. The limit for the maximum monthly withdrawal for the small savings is A, that is rupees 10,000. Okay. Sinking fund is an example of. See, sinking fund is basically an annuity. Okay, I've given you the answer even. Basically, it's an annuity in which we save a specific amount of money considering that the value of the asset goes on decreasing. This is basically a method that is used in depreciation as well. So the depreciation point is different here. Basically, whatever amount of depreciation is there every year, what do? The value is depreciating every year. So when it is depreciating every single year, what will we do then? The depreciation is definitely there, and since depreciation is there and we have to buy another asset after 10 years, because see, if I've got a car for rupees 10 lakh, after 10 years I'll be changing my car. So whatever the depreciation per annum is, I will save an amount equivalent to this as an investment, and I will put it somewhere where I'll get interest on it. So by the end of the 10th year, I will sell off this investment and I'll get that money. I'll also get the interest amount, also get the profit or loss, whatever would be making from that particular investment, and buy another asset. But why do we do this? The point is, we cannot take out a good amount of money from our business at a very at any point of time now. We'll have to make sure that whatever money we are taking out of the business, that is the money which will not affect our capital. So technically that is something which we would never want. That's why we are going to save every single year. So it's basically done on a repetition basis, just like an installment would be going every single year. So that is basically, it's called an annuity for the same reason. Sinking fund is an example of the annuity. Okay. Let's talk about these as well. I think we have talked about it in the previous class as well. Let's talk about the golden rules of accounting. The golden rules of accounting are very, very important because at least one question would be there. With golden rules of accounting, all the assets, this is traditional way. When we talk about all the assets, real account are all the assets which are related to the assets only. Personal accounts are, capital is a part of it, the persons are a part of it. That means any liability towards any specific person is a part of personal account. When we talk about the nominal account, it would include all the expenses and the losses and incomes, and right. So all these things will become a part of real personal and nominal accounts. But accounting along with this is one more thing. When we talk about the golden rules of accounting, there are American rules as well, right? There are two rules. This is the Britishers approach. There is one more approach that is called American or the modern approach. According to that, assets increases on the debit side, the drawings as well as expenses, whenever these three are increasing, it would be shown on the debit side, while the LRC, that is liabilities, then your revenue and your capital, these three, whenever your liabilities, your revenue or your income, or the capital, when any of these are increasing, it would be shown on the credit side. That's the rule for these. That is American approach, right? This is American approach. When we talk about it, there's one more thing. Let's talk about all the various accounts as well. Profit and loss account. Okay, let's talk about the profit and loss account. It's a nominal account. Then balance sheet is none of the above. Balance sheet and trial balance is a statement. Balance sheet and trial balance are statements. They are not accounts. So always remember, they are statements. They are not accounts. So we cannot consider them as a part of the accounts. So that is wrong. Then in terms of this account, P&L is there. Then the statements are there. Okay, let's talk about the trading account. Trading account is again a nominal account. So various accounts and then their nature can be asked. For example, what is the nature of machinery? You will say machinery is an asset, so it is basically real. Goodwill, it is an intangible asset, but it is still considered as a real asset. So these are the values of various accounts. Now let's move on. Capital adequacy ratio is to be calculated as per under the Basel framework applied in India. Eligible total capital funds divided by risk weighted assets, capital fund and risk weighted assets. Eligible total capital funds divided by credit the risk weighted assets and market risk weighted assets and operational risk weighted assets, or paid up capital divided by credit risk weighted assets, market risk and operational risk. What would be the answer here for this question? The correct answer would be C. That is eligible total capital funds divided by credit risk weighted assets plus market plus operational. So this is basically as per the RBI directives of India. The calculation is to be done as per the correct option. The capital adequacy ratio is a measure of how much capital a bank has available reported as percentage of bank weighted, risk weighted credit exposures, right? So this is basically the entire formula for CAR, that is capital adequacy ratio. This is a question of module D. The purpose is to establish the bank have enough capital in their reserves or not, because any bank which becomes insolvent can be a trouble for the entire economy, right? Okay. Here comes the next question, everyone. I'm sorry. What is the denominator of the ITR, inventory turnover ratio? A very important ratio for the examination. So I'll just give you a few of the most important turnover ratios in this question, so that you don't you have the compilation of a few ratios here only. What is the denominator of inventory turnover ratio? Beginning inventory, ending inventory, beginning inventory plus ending, or beginning plus ending divided by 2. When we talk about ITR, it is basically COGS, that is cost of goods sold, or the RFO divided by the average inventory. So it can be anything which is based upon the average inventory. So it is COGS divided by RFO divided by average inventory. Average inventory is basically your opening inventory plus your closing inventory divided by 2. This would be called your ITR, that is inventory turnover ratio. When we talk about the ITR, they can also ask in how many days we are completing it. So it can be 12 or 365 divided by your ITR. This is the time period in which are the days or in the months in which our inventory turns into finished goods and then it is sold. So that is the formula for ITR, right? So and at the same time, another formula in case you will forget, that is COGS as well, cost of goods sold. It is opening stock plus purchases, that too, that is net purchases. That means purchase minus purchase return plus your direct expenses. A question can be asked on the COGS as well, that there can be a numerical question based upon COGS, right? Then direct expenses are added and minus closing stock. This is the formula for cost of goods sold. So in case your GP is given and your sales is given, can we calculate the COGS, everyone? Yes, we can do that. That is going to be sales minus GP is equal to COGS. This means your selling price minus your profit will give us the cost, right? So this is the formula. Okay. The next question, okay, I also said that I'll be dealing with a few formulas as well. Other than this, there are other formulas as well. Here do I, okay, let's few more formulas. I think that would be really helpful for everybody, because the questions will definitely be asked from the ratios. They can ask you questions which are based upon, you just have to tell one particular formula, or you have to tell about multiple formulas that are taken up, right? So that can be based upon, for example, there is one formula called TRTR, that is trade receivable turnover ratio. What's the formula for TRTR? That is your credit sales, because you are going to receive money from these people, na? So basically you take only the credit money. Why? Because the trade receivable means from someone you will be receiving money in future. It is credit sales divided by average trade receivables, and trade receivables includes both. That is, if we talk about the average trade receivables, it is basically opening opening accounts receivable, or we can say our debtor plus closing debtor, and then we have plus, this is your opening BR as well as the closing BR is also a part of it, then you divide it by 2. This is your average trade receivables. There's another ratio called TPTR, that is trade payable turnover ratio. When we talk about the trade payable turnover ratio, it's going to be the credit purchases, because we purchase, that's why we are supposed to pay to these people, so it would be called credit purchases would be made from these people, then divided by the formula would be average trade payables. Trade payables here would include closing creditor as well as the closing bills payable, then plus it is closing, then I'll just take the opening here, opening creditor as well as the opening bills payable divided by 2. And sometimes, yes, there are questions which have been asked where the question can be asked in this way, that they'll give you just the closing values. If they give you only the closing values, assume this is the average only. So if the value of closing is given, whatever the value is, closing debtors or closing creditors, whatever is given, then take that as the average, because they are not providing you the opening value, then closing is treated as the average and you divide it as it is. So remember this point, in case in a question that do not provide you the closing value, then you have to divide it directly. Right? So these are a few important turnover ratios, and all these ratios are basically calculated in times. They are expressed in times. Next question, everyone. The debt equity ratio is 4:1. Current ratio is 2:1. Total asset 20 lakh. Owned liabilities 3 lakh. What is the current assets then? What is the value of current assets? In this question, multiple questions are given. You have to find one particular thing. Such questions can also be asked in a set of questions or a series there. See, the debt upon equity ratio is equal to 4/1. Right? The question says the current ratio CA upon CL is equal to 2 divided by 1. The question says total asset is of rupees 20 lakh. If the total assets are of 20 lakh, owned liability is 3 lakh. That means 20 lakh is basically the money that is invested in the business. That is, total asset is equal to total liabilities. Both of these are equal, right? But the owned equity is of rupees 3 lakh. So technically it's gonna be debt is something which I don't know, but the equity is of rupees 3 lakhs, right? If the equity is of rupees 3 lakhs, then your debt is going to be what amount? It would be the multiplication of these two. The debt will come out to be of rupees 12 lakh. If the long term debt is of rupees 12 lakh, out of the total liabilities, total assets is always equal to total liabilities. So if we have got 12 lakh worth rupees of liabilities, then from there if we deduct 3 lakh, right? So whatever is left, the 17 lakh rupees is our long term liability, is our short term liabilities. Oh, no. Wait. There's a little error there. If out of the total liabilities, okay, liability side we have 3 elements. What are those elements? Number 1 element is share capital. Number 2 is long term debt. And then we have the short term debt. Right? In this question, the share capital was 3 lakh. Then your long term debt is of rupees, they have just taken it out, 12 lakh. So it is 15 lakh already. The remaining amount of 5 lakh, that would be the balancing figure. Since the total is 20 lakh, 5 lakh would be treated as a short term debt. So if it's a short term debt, how do we calculate it? It's going to be current assets of rupees, that is 2/1 is equal to 5 lakh upon that is, current asset is not known to us, but the liabilities is of 5 lakh. So it is current asset is equal to 10 lakh. Right? So we are given a current liability. Okay, I think I hope the answer is also visible now. That is, total assets is equal to total liabilities. When we talk about total assets equal to total liabilities, it's equal to share capital plus long-term debt plus short-term debt. It is 20 lakh is equal to 3 lakh plus 12 lakh plus 5 lakh. So this 5 lakh is basically the balancing figure. If with the total amount of liabilities that we have towards the world is 20 lakh rupees, and we are supposed to get an amount of 3 lakh in our hands now. So basically, what are we going to do here? In this case, what will we do? In this case, what will happen is the total amount of liabilities are basically of 20 lakh, out of which 3 lakh belongs to the equity, 12 lakh belongs to the long term period. For the short term period, it would be 5 lakh. And once you know what is the value of the short term liabilities, it's basically the current liabilities are known to us. Now multiply it and find the current assets. So your current assets in this case will come out to be 10 lakh. Now this question can be converted into a multiple question even. I can ask you what is the value of the long term debt. I can also ask you what is the value of the short term debt. And then in the third question I can also ask you what is the value of the current assets. So there are multiple things which can be asked in this question, because there are 2 or 3 sets of things that you have to calculate for one single question. So that can be there in terms of a case study format, right? Okay, so now let's move on to the next question. The correct answer is 10 lakh rupees. Now, okay, we are done with this question. KYC is done for at least every high risk customers. We are done with this question. That is, for high risk customers it's 2, for medium it's 8, for low it's 10. And on one basis, on what basis we decide whether the customer is high risk or low risk? The basis is that in terms of this area, the basis for high, low and medium risk is that the basis of how many withdrawals are made by that particular person, the kind of account he has in the business and in that bank, or the loan which he would have taken, nature of his business, the amount of transactions he's doing, and what is the number of transactions he's doing with the bank. So these are the various things which would determine whether a particular customer is high risk, low risk or medium risk, right? Okay, here comes a particular question from the area of the here comes a question from the area of forex, right? So how do we deal with this question? When we talk about this kind of question, here you can see the LHS side is all the same, or is it different? LHS is all the same now. So when the LHS is same, we use the chain rule. So let's talk about the chain rule as well. As per the chain rule, when your LHS is equal, then what do? When your LHS is equal, then we basically divide. When your LHS is going to be different, then we will multiply. So these are the various methods which we use in terms of this method, right? Okay, so when we talk about this method, the formula for chain rule. The formula for chain rule is your LHS is equal, then you divide. When your LHS is not equal, then you multiply. That's the formula that we use here. When $1 is equal to rupees 670, 67.75/78. Now this is your bid rate. Whatever the amount is smaller is always the bid rate, and this is the ask rate. B for bid, B for buy. So basically what are we going to do is, we are at rupees, we want to buy Hong Kong dollars, right? But to buy that we have to buy dollars, US dollars. So basically I'll purchase US dollars and sell US dollars and buy the Hong Kong dollars. So how do we calculate this point? We can calculate it by selling or disposing of the dollars. So it would be 67.78. this is the amount of US dollars that we are going to sell, and then we will buy the Hong Kong dollars. What is the amount of Hong Kong dollars? That is 7.52. So what are we going to do? We'll be dividing it. So we'll be dividing 67.78 divided by 7.52. So the value comes out to be 67.78 divided by 7.52. Gives us an amount of 9.0132. So that's the correct answer. So it is 9.0132. In the same question, if I give you another question, it says 1 US dollar is equal to rupees 80 and 1 pound is equal to 1.08 US dollars. So what will you do? Since your LHS is not the same, then you will multiply. How do we multiply? 80 into 1.08. So it would be 80 multiplied by 1.08, giving you a value of 86.4 rupees are required to buy 1 pound. So this is the method that you can use in terms of the chain rule or cross rule. This is the rule. So always remember, if your LHS is same, then you divide. If the LHS is different, then you multiply. Right? So that's the application of the rule. Okay. So we were done with this question. Now moving on to the next question. Goods returned to RAI rupees 3000 recorded through the sales book as 1000. Now debit the sales account with 1000, debit RAI account with 2000, credit RAI returns outwards with rupees 3000. How do we calculate this question? First of all, the goods are returned to RAI. That means we have purchased these goods from RAI. So basically what are we going to do is, it's going to be, we are returning goods na, RAI to purchase return. It would be, this is the correct entry. We were supposed to record RAI to purchase return of 3000, but the recorded through the sales book as 1000. Instead of recording it here, we recorded it as RAI to sales as rupees 1000. So what are the various errors that you can see? The point is, this purchase return was never to be recorded here. So basically one thing is for sure, that purchase return account was supposed to be credited. So with rupees 3000. So credit or the return outwards was the first thing that we were supposed to record. Right? So one thing is sorted, that this point, credit return outward would be credited. Then debit the RAI with 2000. In the RAI's account, 3000 was supposed to be recorded. 1 is already done. Now what will you do? You will record this 2000, the remaining. RAI's account was basically undercast. It was supposed to be recorded at 3000 but recorded at 1000. You have to debit more. So basically this is to be recorded as well. That is also true. Now the debit the sales account. Now the last point that is left is, why is this sales account still existing? This account also has to be cancelled now. So we'll cancel this account of debit the sales account with rupees 1000. So all these three are correct. So the journal entry that would be required is RAI's account would be debited with rupees 2000, right? And then sales account would be debited with rupees 1000, and the purchase return account would be credited with rupees 3000. So this would be the entire correct journal entry that would be passed in the books of accounts. Right? Now moving on to the next question. The next question is, okay, this was the answer. Goods returned were wrongly recorded through the sales book as rupees 1000. Rectification entry would be given in such basis that we have already done. RAI account debit, sales account debit, and the purchase return would be on the credit side. Right? So now moving on, ABC Limited gives the following balance sheet. The balance sheet is equity, reserves, debentures, funds and creditors. So these are all the areas of the liabilities, right? And these are all the areas of the assets. So what we can do is we can also check it from this area. What will be the total? It would be 15 lakh plus 1 lakh plus 3 lakh 1 lakh plus 2 lakh, giving us a total of 22 lakhs here. And then we have 14 plus 5 plus 2 plus 1. That means both the sides are clearly stated. The asset side would be of 22 lakhs and the liability side is also of 22 lakhs. Then the question says you are required to compute the liquidity ratio. When we talk about the liquidity ratio, what is the formula? When we talk about the liquidity ratio, it's basically liquid assets divided by our current liabilities. Liquid assets includes all the current assets, but it does not require the inventory, because inventory takes time to be to give money. Now if I want to sell away my inventory and get money for myself, then it is not possible. It will take time. First is inventory. Number two that we are going to record is inventory, and number two would be the prepaid expenses. When we talk about the prepaid expenses, these are those expenses which would be incurred. See, if I have got a SIM of prepaid prepaid communication, say I've taken an Airtel SIM that is prepaid. If I pay for 3 months together, if I need money today, can I go and ask Airtel that please give me my money back so that I can pay it somewhere else? No. Once the amount is paid, till the time that the time doesn't expire, that amount cannot be taken back. So basically these prepaid expenses will not be a part of it. And inventory takes a lot of time to sold out. So basically that will not be included as well. So then when we have to take the liquid ratio, it would be liquid assets divided by current liabilities. Now let's find out where are the liquid assets. Fixed assets are never liquid. Stock has already been taken out. So the remaining is debtor of rupees 2 lakh and the cash of rupees 1 lakh. So our liquid asset is of rupees 3 lakhs, right? And then we have the current liabilities. I can see only two current liabilities, that is overdraft as well as creditors, as debenture is a long-term liability, reserve fund is also a long-term liability, and equity share. These two, equity and reserves, these are shareholder funds, while debentures is a long-term debt. So it would be 3 lakh again. So technically both are turning out to be 3 lakh. So what would be the answer? It would be 1:1. No, overdraft is also considered as a long-term liability. It's like a short-term liability, not a long-term one. So it would be treated here only. Recently, no, I'm sorry. Recently what I've seen is in terms of AS3, that is accounting standard 3, cash flow statement has stopped taking overdraft as a short-term liability. Now it's a part of the long-term liabilities. So that's the same point. If you consider the long-term liability here, then it would be 1.5, and probably this is not even 1:1. The answer would have been 1:1 if we consider it. So I think we'll go with that point, that we are considering it as 2 lakh only. Then the answer would come out to be 1.5 lakh. Otherwise, overdraft was earlier considered as a part of it, but now it has become a part of the long-term loans, right? Okay. Now the next question that comes is the solvency ratio. When we talk about the solvency ratio, it would be debt. The solvency ratio is debt upon equity. Do you have enough that you can pay off your debts or not? That is debt upon equity. You have to find the long-term debts. The long-term debts here would be 3 lakh plus 1 lakh, because considering the overdraft as long-term, it would be 4 lakh altogether. That is the total debt that you have. That is 4 lakh rupees divided by what is the amount of equity. Equity means whatever money the owner is investing in the business. It would be 1,50,000, sorry, 15 lakh, and then we have 1 lakh, that is reserve fund. Whatever money we didn't take out of the business, that is called 1 lakh rupees. So it would be 1 lakh here. So it would be 4 lakh divided by 16 lakh. So what would be the answer in this case? Then it would be treated as okay, it's No, this is not right. There's something wrong about it. Debt is always only the long-term debt. This question is wrong. Whenever we calculate the solvency ratio, it is always long-term debt upon equity. Only a few books or authors have taken it as, oh, the long plus short term, otherwise it's not a part of it. It's only the long term debt upon equity. So I think there's a question, there's something wrong with the question, so let's leave this question, because the correct answer is long term debt has to be taken, not the long term plus short term debt. Solvency ratio is all about the debt upon equity. So here the debt means only and only the long term ones, not the short term ones. So basically the current liabilities are not going to be a part of it. This is not the correct answer. So leaving this question altogether. Okay. Then again, I think the same question is going on, so I'm just leaving the entire question, because when we talk about these ratios, when we talk about current ratio, it is CA upon CL. When we talk about liquid ratio, it is that is liquid assets upon CL. When we talk about our solvency ratio, or solvency ratios are those ratios which talk about the long term debts when we take, whether we are able to pay it or not. Among them, there are basically ratios. Debt equity ratio is one of them, that is debt upon equity. And when we talk about the debt ratio, it is debt upon debt plus equity ratio. This is debt ratio, right? This is called the debt ratio. And when we talk about the proprietary ratio, it is your shareholders funds divided by total assets. So these are the various ratios which are really important, can be asked in the examination. So in one particular area, I've given you all the ratios together. So first of all, that we are talking about is current ratio. Current ratio is CA upon CL. When we talk about liquid ratio, it is liquid assets upon CL. Then debt ratio is debt upon debt plus equity. Proprietary shareholder funds divided by total assets. Solvency is debt upon equity. So the correct answer here would be okay, in this is not a question anymore. So these were just the various formulas that I've given you. I hope with every time we are revising it, you will be able to learn it in a proper way. Now the next point is stock of working capital ratio is CA minus CL. So this is the current working capital is CA minus CL. So there, how do we calculate it? CL as well as CA. First of all, here we'll be taking up the CL as 3 lakh, right? And the CA was current assets. All the assets were there. So we have just deducted 8 lakh minus 3 lakh, and then that is our 5 lakh. So for working capital ratio, normally what we do is stock divided by working capital. Stock of working capital we're taking. So we're taking stock by working capital. Otherwise, if working capital turnover ratio is given, it is RFO, revenue from operations divided by working capital. So there are various formulas. You have to look forward to the formula which you are trying to look forward to. If a working capital turnover ratio is given, then it is RFO, revenue from operations divided. RFO is basically the sales. So you divide it by the sales with the working capital, right? So that would be the answer. Another formula being done? Okay, here comes the next question, everyone. Okay, here comes the next question. An item of revenue expenditure had been incorrectly treated as a capital expenditure. there was some revenue expenditure. That means there was some expense that was recorded incorrectly as a capital expenditure. That means it was probably treated as an asset. What is the effect of this error? When such an error occurs, what will be its effect? Will it be a non-current asset is understated and profit is overstated, or non-current assets understated, profit of the year is understated, non-current assets overstated or profit for the year is overstated, non-current asset overstate and profit understate? Now let's talk about it. Recorded as an asset, something which wasn't an asset was treated as an asset. That means it was a capital asset, is overstated. It is shown more than its actual value. While when we talk about the expenditure, expenditure will here mean there the profit is shown more. Why? Because the expense is not included. So what would be the answer here? Your the assets are overstated, profit is also overstated. So answer would be C. Always think about the accounting from the point of view of genuinely the accounting, rather just going on with a random point. Think why is it important. See, if you're recording it as an asset, that means your asset is increasing, and if your expenditure is not recorded, that means our profit is increasing. And why? Because profit is how we are earning profit. We are earning profit, that is income minus expenditure, right? That would give the answer. So then in this case the correct answer is C. Okay, the next question is lockbox system. Under lockbox system, what happens? It reduces the need for compensating balances. It reduces the security for late night deposits, or reduces the risk of having checks lost in the email, or accelerates the inflow of funds. The lockbox system is basically a fund which is basically a bank operated mailing address, right? It's a bank operated mailing address which is used to by the banking company, which directs the people to send their payments. So basically whenever the bank opens it comes to know about the deposits which have been made, or whatever is happening with the payments and the expenses that are being done. So whatever amount is coming or going, that is being recorded in that area. So basically it helps in accelerating the inflow of funds. So the answer here would be D. It accelerates the inflow of funds. As I stated, when we say about a lockbox system, it is a bank operated mailing address to which a company directs its customers to send their payments. Whenever someone has to send the payments, then these people would be asked to pay in that particular area. It's a mailing address. So where you send the money, right? As soon as the bank opens that mail, then what will happen is they will get all the amount that is received by them from the people. That means this all received funds in the company's bank account, and scans these payments and any remittance information, whatever the remittance information is there, they will scan it further, right? That is lockbox system. Okay, here comes the next question, everyone. Compensation paid to workers under voluntary retirement scheme. If we are paying to our the workers who have worked with us for so long, and then you are recording their value, what will you do there? The compensation paid to the workers under voluntary retirement scheme, will it be treated as a capital expenditure, revenue, capital receipt, or revenue receipt? Basically any money which you are paying to the under VRS, you are paying any specific amount. This benefit is basically shown in the revenue expenditure, whatever amount is going, because it will not help to increase our revenue generating capacity. Our the capacity of generating the revenue will not increase by giving payments to those people who have worked for this organization for so long, right? It would be treated as an expenditure and would be taken away, right? Okay, next question. Rupees 90,000 being expenditure incurred for well-equipped labor welfare center. So what are we doing? We are basically opening up a well-equipped labor welfare center. That means this area is basically where the labor will sit down. Their area would be, this is basically investing in infrastructure now. Is it a capital expenditure, revenue expenditure, capital receipt, or revenue receipt? When we talk about this 90,000 being expenditure on well-equipped labor welfare center, it's a labor welfare center, it would be treated as a capital expenditure. Okay, it's a permanent addition because again we are helping our laborers to get the basic infrastructure that would help them further in terms of their comfort. Na? So basically, it's a only. It's a capital expenditure. Any expenditure that you are incurring which would increase your asset. Asset is not something which gives revenue. It becomes the source through which you can further increase your revenue. Right? It would be treated as an asset. Okay, here comes the next question. The insurance claim received on account of machinery damaged by fire. Is it a capital expenditure, a revenue expenditure, capital receipt, or revenue receipt? When we talk about the insurance claim, see, insurance claim is where we have faced any kind of damage or something, right? So, when we have faced any damage or something, then what will we do with that damage? uh, the insurance claim received on account of any machinery damaged by fire, it would be adjusted in such a way that it would be treated as a capital receipt because we are being compensated for a particular asset which we have lost. So it would be treated as a capital receipt. Okay, when we talk about the capital receipt and the capital expenditure, how do we deal with it? The capital receipt and capital expenditure can be treated as further. That means purchase of an asset or item which are lost for more than a year, they would be treated as a capital expenditure. The benefits of which would be reaped for more than a year are under capital expenditure, and any expenditure which are being incurred in terms of which are done for this particular year, it's payment of expenses or items that last for less than a year, that would be treated as a revenue expenditure. This is the crux of the capital expenditure and the revenue expenditure. In any receipt that you receive because of any liability being generated or an asset being taken away from some by someone else, then it would be treated as a capital receipt. When you receive money by bidding goodbye to a liability, or basically bidding goodbye to an asset or receiving any kind of new liability, that is capital um, receipt. Then we have in terms of revenue expenditure, it would be here, it would be revenue receipt, right? So these are the various areas that is available for us. Now comes the next question. Amount received from IDBI as a medium term loan for augmenting working capital is capital expenditure, revenue expenditure, capital receipt, or revenue receipt. The amount received from IDBI as a medium term loan, when you are basically see, sometimes now we need a short term loan which is required to cater our long term purposes as well. So basically that is something in terms of financing area, sometimes we call it bridge financing. To get a major loan we sometimes take a minor loan as well. This can also be done. So basically amount now in this case what is happening is we are taking a medium term loan. We cannot say it's a short term loan. If we are taking a medium term loan, then it would be treated as a long term liability or a short term liability. It's a long term liability being generated. We are receiving a money, that means it's a capital receipt, right? Okay, here comes the next question. The preference shares of a company acquired shortly before their specific redemption is covered under operating activity, investing activity, financing activity, or cash and cash equivalents. When we talk about this, the preference shares of the company which are acquired shortly before their specific redemption, it's basically we have just got them and we'll be getting rid of them soon now. So basically it's just that something which is bought so that it's just gonna materialize very soon into cash. So it's called a cash and cash equivalence. Anything which can be converted into cash very swiftly would be treated as cash and cash equivalence, right? Okay, now let's continue with the next question. The next question says a partner that doesn't take part in the management of a business but he or she has made investment in the business and is liable to creditors of the business is known as active partner, nominal partner, junior partner or dormant partner. This partner is not an active partner, basically it's a sleeping partner. Such partners are not active, so they are called dormant partners. These people just give money to the business and they stay away from it. They just don't want to take in decisions, but they want returns from it. So they are called the dormant or the sleeping partners. Just like we have dormant accounts now, just like that. In capital budgeting, the term capital rationing implies that no retained earnings are available, that limited funds are available for investment, that no external funds can be raised, or that no fresh investments is required in the current year. So what will we do in this case? What would be the correct answer? It would be, see, in terms of capital rationing means we are allotting the funds in such a way. We have got 1 lakh, we have to allot this money among various projects, project A, project B, project C, and how are we going to provide that particular amount into various areas? That is something we are going to see. So basically in this case the correct answer would be the when there are limited funds available for investment, and we'll decide how are we going to use that money. That limited funds are available for investment. Okay, here comes a particular question on the method of depreciation only. That S Limited purchased a second-hand machine for rupees 8,000 on 1st of July 2015. Remember, it is 1st of July. Then they spent 3,500 on overhaul and installation. Depreciation was written off at 10% on original cost. Again, a question of original cost in the examination. There can be a question on SLM method as well as the question can be on WDV. The differences in SLM method, there is a fixed rate of depreciation, while in terms of WDV what happens is if the depreciation rate remains same, it's called fixed rate method. If the depreciation rate becomes the same, 1 lakh, the depreciation is 10%, it would be 10,000 only, right? Whatever we are left with 90,000 rupees, so the next is 9,000 on it. It's 10% of 90,000. It's not on the original value, it's on whatever is left. By the end of the year, depreciation would be charged on that. That would be considered. Now, the question is depreciation is written off 10% per annum on original cost. On 30th of September 2018, the machine was found to be unsuitable and sold for 6,500. Prepare the machinery account for 4 years, assuming that the account are closed on 31st of March. The question says, what is the depreciation for the first year? Easy question. Why? Because in this case, all you need to find out is what is the value on the first year. If the value is 8,000, shall we take it 8,000 or we add up this 3,500 as well? We need to add up this 3,500 as well. Why? Because in this case, what are we going to do? It's going to be 8,000 plus 3,500. Why? Because this 3,500 is also a capital expenditure, any expenditure that you are incurring on your particular asset, right? Because you want to keep that asset alive now, so you have to calculate this is ready to, when till the time the asset is not ready to use, we'll calculate it accordingly. So it is basically 8 plus 3, 11,500 is the value of the asset, but it's purchased on 1st of July. That means April, May, June. It's not there for the first 3 months. 11,500 multiplied by 10% because the depreciation rate is 10%. It would be 11,500 multiplied by 10% multiplied by how many months are there? 9 by 12 into 9 divided by 12 will give us a value of 862.5. So 1150 is for the entire year. This is given just to confuse you. Remember, it's purchased on 1st of July and not used for the first quarter at all. So it's 863. Purchase a second hand machine for 8,000 on 1st July 2015. They spent 3,500 on the overhaul and installation. Now the question says, what is the book value at the end of the 31st March 2018? That means we are looking forward to whatever the value is by the end of that year, right? This is the second year. Okay, we bought it in 2015 to 2016. then 2016 to 2017, then is 2017 to 2018, right? Till this, what is the value on 31st March 2018? It was 863 rupees in the first year, considering it wasn't used for the first quarter. Then it is 11,500 for the entire value. Now the value of this machine is 11,500. Then calculate at the rate of 10%. It is 1150, then 1150. So it's gonna be 863 plus 1150 plus 1150. The total deposition that is to be charged is rupees 3163. Total deposition is 3163. So from the value of 11,500, we will deduct 863, then 1150, then 1150. So depreciation is total of after charging depreciation of 3163 from the original value of the asset. What's the original value? It's 11,500. From 11,500, when you deduct this value, then you will get 3163. The total value that you are left with is 8337. That's the answer. Okay. Now moving on, the S Limited, the next question is depreciation in the last year. We are still not done yet, isn't it? In the first year it was 863, for the next 2 years it was 1150. Now the question says, what's the value at the end of the last year? See, the value of the asset was 11,500 in the last year. That means from 2018 beginning to, what is the value? On 30th of September 2018, used for 30th September. That means April, May, June, July, August, September. We have used it for 6 months, right? We have used it for 6 months. So it's 11,500 multiplied by 10% multiplied by 6 by 12. So it's going to be 11,500 multiplied by 10% multiplied by 6 divided by 12. It's going to be 575 rupees. Right? So this is going to be the depreciation for the last year. Okay, now comes the question. The question says, what is the loss on sale? If all the above points are correct, only then this will come out to be correct. I'm just considering or recollecting all the points that we have done till now. Depreciation in terms of 2017-18 was, before 2017, what was the value? It was 8337. From 8337, that is 8337 was the value in 2018 31st March, right? Was 8337. From here, shall we deduct another 575 rupees, which was the value for that last year? The value comes out to be 7762. The value of the asset by the end or the day on of its sale, it's 7762. While we are selling it for 6500, we are selling it for pennies, isn't it? Minus 6500. Now if this is your book value and your sales value is 6500, then what is the value? It would be 1262. So it would be 1262. Value would be 1262. Okay, so this is the entire question. Okay, now moving on to the next point. Annual cost savings of 4 lakh, useful life 4 years, cost of the project 11 lakh 42. The payback period would be, one or the other question in the examination can always relate to the cap budget, because capital budgeting is a topic which has multiple points starting from this area that we're talking about, that is in terms of the annual the payback period. We have 3-4 methods there: payback, accounting rate of return, NPV, IRR, as well as the profitability index. I'll just give you a brief of all these methods after we are done with this question, right? Okay, the question says annual cost saving is 4 lakh rupees. Okay, annually we are saving in 4 lakh rupees every year. In the year 1 we have saved 4 lakhs, in the year 2 we have also saved 4 lakhs, in the year 3 we have also saved 4 lakhs, and in the year 4 again we have saved 4 lakhs. What's the issue then? It's 1, 2, 3 and 4. The payback period would be, what is the payback period? When we talk about the payback period, payback period would be what? That would be 2 years are definitely taken. After 2 years, since it is 4 plus 4, 8 lakh done. Then when we talk about 8 plus 4, it would be 12 lakhs here. The cumulative, the cash flows would exceed the value that we want. That means 2 years are definitely required. After 2 years, we do not know how much time. It is less than 3 for sure. How do we calculate it? It would be 12 lakh is, okay, the value that we're looking forward is 11 lakh 42,000. Till now, we have incurred an expense of 8 lakh rupees. Now we will divide it by how much time? 11 lakh 42 minus 8 lakh divided by whatever value would be there in this particular year of the year in which we are completing that point. Whatever value we are supposed to incur, that is 11 lakh 42 is what we want as a payback. 11 lakh 42 minus 8 lakh, whatever has already been done with, divided by 4 lakh. It is going to be 11 lakh 42,000 minus 8 lakhs is going to be 3 lakh 42 divided by 4 lakh plus 2. It would be 2.855. Now the point is, if I'm given 2, the answer is coming out to be, okay, I think for a better visibility, the value is coming out to be 2.855 years. Now how do we calculate it? 2.855 years can be converted into 0.855 multiplied by 12. Just convert this point of 0.855 because they want in terms of months now. So what can we do? These two are out of the window, but these can be there. So what month? 2.8 months or 2.11 months? The value, they're now converting this 8.855 in 1 year. How many months are there? We have 12 months. So the value will be 10.26 months. So it would be near about 11 now. So the answer is B, not A. Many of you would be running towards A because we have got 2.855. But the point is 855 is still in terms of years, not in terms of months, everyone. So that's the basic mistake you might be making if you're looking forward to this question, right? So the correct answer would be 2 years and 11 months. So it's 2.855. Okay. Now, just the crux of the entire capital budget, a quick capital budgeting decision. When we talk about the cap budget, or we say the capital budgeting, when we talk about the method of capital budgeting, how do we deal with this method? In terms of capital budgeting, we have two kinds of methods. One method, there are two methods of capital budgeting can be, okay, number one is the traditional method. The second method is the modern method. When we talk about the traditional method, it can be divided into the methods which are covered under traditional is payback period. Number one is payback period. Number two is accounting rate of return. We are just done with the payback period. Then in terms of modern, one is net present value, second is IRR, and third is called the profitability index. So these are the three methods which are used under modern, and those two are covered under traditional. And sometimes under modern they also call it, there is another called discounted payback. That is also there. In the examination, the question can come up of NPV, ARR, any of these, because every part of the capital budgeting has a numerical. So if they are putting it into the case study area, then that definitely it's going to take a lot of time for you, right? So we have just done with this. Let's talk about the ARR as well. If ARR method is to be used, whatever your savings is or whatever your income is that you are making from that project, divided by the initial investment multiplied by 100. This return is basically calculated in terms of percentage. That is called accounting rate of a return method. I think I'll be dealing with one or with the other question of NPV in the remaining part. And now let's talk about the PI, profitability index as well. In terms of profitability index, what do we do? The profitability index is basically whatever total returns you are, discounted total returns, discounted cash flows of that particular area divided by initial investment is done. discounted cash flows, whatever amount you are getting, that too not as per present but as per future, which is taken towards discounting, and we are trying to find whatever is the value of what if I say I'll receive 100 rupees in future, what is its current value. I'll be taking out all the current values, adding it up, and then dividing it by the initial investment. And in this area there are a few things which are very common, so let me tell you that particular point as well. So the major portion of all these transactions would be done, right? Okay. Let's talk about this way. When we talk about the profitability index, in this, whenever you have the initial you have the cumulative CFATs divided by the initial investment now. So what do we do? In case your profitability index is more than 1, then only you accept that project. If your profitability index is less than 1, we will reject it. And when your profitability index is equal to 1, then it's an indifference point, which it doesn't matter whether we take it up or not. That is called indifference point, right? Okay, now let's move on and deal with the next question, everyone. Determine the inventory turnover ratio. They've asked to calculate the inventory turnover ratio when your opening stock is given, closing stock is given, as well as the COGS is given. And this basically ITR, or inventory turnover ratio, is COGS divided by average stock. How do we calculate it? COGS divided by average stock. COGS divided by average stock can be calculated. The COGS is 2,40,000 and opening stock is 29,000. Closing stock is 31,000. What's the average of these two? It's going to be 29,000 plus 31,000 divided by 2. It's 30,000. The average stock is 30,000. So it is 2,40,000 divided by 30,000. It would be 8 times, right? COGS upon average stock, opening plus closing divided by 2. That's the formula that I use. That is 29,000 plus 31,000 divided by 2, giving us the correct answer. That is 8 times. Moving on to the next question, everyone. The price at which one can enter into the contract today to buy or sell a currency 30 days from now is called. If I want to purchase a currency after 3 months or maybe 4 months, whatever the time period is, I'm not buying it today, but I'll be buying it in the future. Is it a reciprocal exchange rate or effective exchange rate or effective rate option, or the last one? It's a forward exchange rate. It is called a forward exchange rate. It's D. Right? Next question, everyone. Okay. In terms of capital rationing, again a question of cap budge, right? In terms of capital rationing, a company is compelled to invest in projects having shortest payback. See, the point is the organization has limited amount of money. The point is that if they have limited amount of money, they are always in the rush that when will I get my money back. They are so much worried about that thing, and they are supposed to be, no? The shorter the payback period, the less risky is the project. Therefore, it can be considered as an indicator of risk. Select the correct answer from the options given below. Statement 1 is true or statement 2 is false. Statement 1, 2 is true and the first one is false, or both are correct and both are false. What can be the correct answer? See, if the organization is so much worried about their presence now, so what do? They are so much worried whether they'll make enough money or not. uh, they are just worried about the payback. The capital rationing means they have limited amount of money and they are putting it wisely in terms of, say, project 1. No, we're thinking about the project 2. They are just thinking about it in a very sorted manner. They are running over it, right? In this case, the correct answer would come out to be both are correct. The point is that sometimes the projects are risky and the particular person can be in a crunch in terms of money. Now what they're dealing with, they are ready to put the money and they're just running, whenever I'll get the money back, I'll put it somewhere else. So he's just being wise, and that is true, right? So this would be a true answer. Both statement 1 and 2 are true. Okay, here comes the next question, everyone. X Limited purchased a machinery for rupees 1 lakh with a useful life of 5 years. The amount of depreciation using the double declining balance for the year 2 is 25,000, 24,000, 23, or 30. What would be the correct answer? X Limited purchased a machinery for rupees 1 lakh with a useful life of 5 years. The amount of depreciation using the double declining balance method would be for the year 2. Year 2 we are looking forward to now. So let's do it. X Limited purchased a machinery for 1 lakh with a useful life. Whenever, see the what is the formula for double declining method? It is 1 divided by life of asset, and we will multiply it by 2 multiplied by 100. That's the method that we use here. So here in this case, 1 divided by life is 5 years now, multiplied by 2 multiplied by 100. So the percentage would be, we are just trying to find the value. 1 divided by 5 multiplied by 2 multiplied by 100, right? So the percentage here would be 40%. I think normally it would have been 20. Now here it becomes double of it, it is 40. Now if we have got 40% of depreciation, so they are saying that the amount of depreciation to be charged in the second year, if the value is 1 lakh for the first year, then 1 lakh minus first year we had 40,000, whatever we are left with is 60,000. From this 60,000, 40% of it has to be reduced. What is the 40% of 60,000, everyone? 60,000 into 40% comes out to be 24,000. So 24,000 would be the depreciation for the second year. It is B. Right? So here comes the next question, everyone. The net profit before the following adjustment is given. Okay, the correct answer was 40%, and this is where it is the whole calculation is shown. In the first year, the written down value was 40,000, the value which was left, and then from that 60,000, the value that was 60,000. For the second year, the depreciation would be 60,000. On 60,000, we'll calculate at 40%. This is what I was telling you. This double declining method is a mixture of SLM and WDV. What happens is you have a percentage which is double of your SLM based upon the life, right? So it is 20%, then for 1 lakh minus 40,000, 60,000, 40% now. It was 40%, it is 40,000 is declined. So what are we are left with at the end of year 1, we have 60,000. Now we'll take a depreciation of 40% of its 6 fours are 24. 24,000 would become its depreciation for the second year, right? So the correct answer would be this. Now moving on to the next question. Net profit before the following adjustment of 1 lakh 50, outstanding salary is 10,000, prepaid insurance stress 20,000. Profit from the statement is A, B, C and D. What would be the correct answer? See, the net profit is of 1,50,000. Net profit is 1,50,000. When we have as per the matching concept, whatever belongs to this year should be adjusted in this year. If we have got an outstanding salary of 10,000, we'll add up this amount. Now, this amount is supposed to be charged. Prepaid insurances of rupees 20,000 has to be charged again. This belongs to the next year, not this year. So why are we putting it in? It is 1,50,000. Then plus 10,000 minus 20,000. Right? The value will come out to be 1,40,000. Prepaid insurance means insurance belonging to the next year, hence less. Then outstanding a salary, that means salary this belongs to this particular year, hence it would be added. So the correct answer is 1,40,000. Got it, everyone? Okay, now let's move on to the next question. The correct answer is forex rate in Delhi of $1 is 48.8090, and then in London €1 is equal to US dollars 1.6065 pounds sterling. Then we have what is the cross rate for euro? What would be the cross rate for euro here? See, your LHS is varying. What are we going to do about it? Would be okay. In this question, always keep an eye. It says $1 is equal to 48.80 and 48.90, and we are looking forward towards the cross rate for euro. We are standing at rupees now, and then we have €1 is equal to US dollars 1.60 and 65. In this case, we are looking forward to this now. The question is basically regarding $1 is given, and $1 is again stated with terms of euro as well. In this case, we will have to multiply. This is the case where you'll have to multiply, and that would give you it would be basically okay. In this case, it would be 48.90 is the value, 48.90 is the selling value, and 1.60 is your purchase value. It would give you around 78.24. So there the nearest point is A. It is 78.08. This would be considered as your answer. Right? Okay. Now this was the question, that is $1 is equal to rupees, and then we have €1 in terms of dollars, and here will be multiplying. Okay, now comes the next question. The question says debt equity ratio indicates the long-term solvency of the company. It measures the ability of the company to pay off its long-term liabilities. Select the correct answer from the following code. Both A and R are correct. R is the reason. Both A and R are correct, but R does not explain it. Or A is correct, R is wrong, or A is wrong, but R is correct. Debt equity ratio is a long-term solvency ratio, as we talked about when we were talking just about the ratio area. This is correct. It is basically a long-term solvency, whether I can pay you off over the period of time or not. It measures ability to company to pay long-term liability. That is also correct. So basically both of these are correct, and this is the correct explanation for the point as well. Next question, the inventory method that will always produce the same amount of cost of goods sold in periodic inventory system as per the perpetual inventory system would be. What would be the answer there? Okay, in this system, whatever the same amount of cost of goods sold would be there. That is because of the area of first in and first out. That is FIFO. If we talk about LIFO, it is last in and first out. Right? FIFO is the ability to have the same amounts of for ending inventory and cost of goods sold regardless the use of periodic or perpetual inventory systems. Okay. Now comes the next question. Almost all the topics of depreciation are covered here. We're done with SLM. I've also explained the WDV. I've also explained double declining, and here comes the question of sum of the digits method. The question says original cost is 1,36,000, salvage value is 10,000, useful life is 6 years. Depreciation for the third year. How do we calculate depreciation for the third year? It would be for in terms of sum of digits method, we have what is the remaining life. In the first year we have 6 years left, in the second year 5, third year 4, then fourth year 3, then 2, then 1. Then in terms of the salvage value, we have 1,36,000 minus 10,000. Right, this is the value. 1,36,000 minus 10,000 is your depreciable value. The total value which can be depreciated is 1,26,000. Now currently we are standing at the third year, so it means 1, 2 and 3. But in the beginning of the third year we are left with third, fourth, fifth, sixth. The depreciation is still left for 4 years, so it would be 4 upon, what is the total of it? It is basically 6 plus 5 plus 4 plus 3 plus 2 plus 1. It gives us 21. So we are looking forward towards the depreciation now. The depreciation would be 1,26,000 multiplied by 4 divided by 21. It would be 24,000 rupees. The correct answer is D. So we are done with all the methods of depreciation. We are done with also almost all the methods of the CAIIB in this particular session only. And many of the formulas of ratios as well. We have just revised all that, and along with that we are also done with a few questions of rectification plus module D. So I've tried to cover all the topics. Now this is a part of AS2, there is a part of module B again. Okay. As per the AS2, the historical cost of inventories should be normally be determined by using FIFO and weighted average, FIFO and LIFO, LIFO and weighted average, and FIFO and simple average. When we talk about as per AS2, the historical cost of inventories should be normally determined by using. The historical cost is not used in terms of LIFO at all. LIFO is something which is avoided. So basically it is basically FIFO and the weighted average. These are used frequently as per AS2. And AS2 says cost or net realizable value. This part can be asked in the examination. What is the basic core crux of AS2? It says you record it at cost or NRV, whichever is that would be recorded. That's the answer for this method, whichever is less. Okay, as I told you, I'll cover one particular question of NPV as well. Now the last topic of NPV, the CAIIB is also sorted. That is NPV method. Then project A gives a cash flow of 10,000 annually for 3 years, while project B gives a cash flow of 6,000, 8,000, 16,000 for 3 years. The initial investment is 24,500. NPV is also given, and they are asking you what is the value NPV of project A. Okay, let's talk about the project A only first. Okay, the value of the project is basically 10,000 is the value of the initial investment, right? The initial investment is of rupees 10,000 and it is done for 3 years. Okay, and then for project A, initial investment is of rupees 24,500. It is 24,500. In terms of the project, what is happening is, in terms of project A, we have 10,000 in our hand now. So when we have this amount, what do we do here? We'll be having 10,000. That is something that we'll be receiving every year. First year, second year, and there it is our third year. So we have got 10,000 in every year. So how do we deal with this question? We have got it for 3 long years. But the point is, what would be the PV? For PV factor, we have to use 10%. So how do we calculate the PV factor? You can calculate it using your calculator. Okay, I'm showing it to you. I hope this is sorry. I hope this is visible now, right? It would be 1, then we will divide it by, the value is 10% now, what there is 1 plus 10% is 1.1, so I'm dividing it by 1.1. Now the first value is equal to 0.909, then click equal to again, then 0.826. For the third year it would be 0.751. This would be the PV for those 3 years. So what I can do is, since the value is 10,000, all I need to do is I need to multiply it with these. This is 0.909, 0.826 and 0.751. So in is equal to, and we'll get the value. So in terms of this, the value will come out to be, we will have to multiply these terms and we will get the values over here. The total of this will come out to be 24,868. What was the original value? We invested 24,500. Now we invested 24,500, and here we are getting a negative value just by taking up the various values. There is an approximation. My value is coming at 368 rupees. So the nearest is 360. So this would be the answer, because I am making more than 24,500. That is the original value, it is 24,500. So value is 368 rupees here, minus 368. The correct answer is 360. Near about value should be taken, but the difference is because of approximations that I took. I took the exact values, they would have taken the approximate value. So always find out the nearest value. Okay, here comes the next question. The PV factor is 10%. NPV of both the projects would be, it would be for project B, we have 6,000, 8,000 and 16,000. Right? So these are the values which are given, and how do we look forward to it? Now it is multiplied by 0.909, now multiplied by 0.826, now multiplied by 0.751. Since the PV factor is not changing, only the cash flows are changing. So it would be 6,000 multiplied by 0.909. Then the next point is 8,000 multiplied by 0.826, then 16,000 multiplied by 0.751. So the total will come out to be, this total would be 24,078, right? This would be the answer and it would be deducted. In this case we are having a negative point. But after investing so much, we have invested 16,000, 8,000 and 6,000. Basically we have invested 24,500 and we are, what are we getting? We are getting 6,000, 8,000 and 16,000, but the value is coming which is less, right? It would be minus 24,500, giving a value of negative 422. It's negative right now. So that means project B should not be accepted. There can be another question, which of the projects should be accepted or rejected. Project B should be rejected on the account of having a negative 0.422, while the project A is having a positive point. The answer is negative 422. This should be rejected. Comes the next question, everyone. The numbering is just there. So kindly avoid it. This is not the number. Okay, go ahead and answer this question, everyone. Okay. Go ahead and answer this question, everyone. one of the following statement is not true? Which one of the following is exactly not true? And then expenditure intended to benefit current year is revenue expenditure. Amount paid for acquiring goodwill is a capital expenditure. Wages paid for installation for a new machine is usually debited to wages account. Revenue expenditure is not intended to benefit the future expenditure. Which one is not true? This is not true. Wages or for installation is a part of the capital expenditure, not a part of the revenue expenditure. So I think C will not be a part of it at all. Wages paid for installation or for a new machinery is usually debited to the wages account. It's a part of the machinery account. It's not a part of anywhere else. C is wrong. Which of the following methods of capital expenditure assumes that the cash flows are reinvested at the project's rate of return? Still left with a good amount of questions. Hurry up, everyone. What would be the answer there? Which one of the following is assumes that cash flow are reinvested in the project's rate of return? That method is called IRR. Under internal rate of return, that amount is reinvested in the project's rate of return. That is internal rate of return. CAIIB budget in all aspects with all the various ratios is completed there. Then comes the negative net working capital, implies that long-term funds have been used for fixed assets, short-term funds have been used for fixed assets, long-term funds have been used for current assets, or short-term has been used for current assets. What would be the correct answer? When you use your short-term funds to invest in terms of any long-term area, so that is where your present money gets choked up. So the correct answer would be B. Okay, here comes the next question regarding profitability index. Profitability index of a project is the ratio of the present value of the cash inflows to total cash outflows, inflows, outflows, or present value of outflows, or initial cost minus depreciation. Okay, we're looking for ratio of present value of inflows divided by your initial is a ratio of present value of inflows to Acha, haan, this is inflows na initial investment, but we do not deduct the depreciation out of it. If it would have given only initial cost, I would have taken this answer. So it would be the total cash outflows, whatever we would have paid till now. This is basically your initial investment only. It's just a return in a very smart manner. Right? It's PV in terms of PI, profitability index in terms of initial investment. Achha, which of the following variables is not known in IRR of capital budgeting? Amount of cash outflows, discount rate, amount of cash inflows, or life of the project. Which one is not following? We do not know the discount rate. That is what we work towards in terms of IRR. Okay, if you're talking about IRR, what's the formula for it? The formula is lower rate plus the cash flows at the lower rate, the discounted cash flows at the lower rate, minus initial investment divided by the cash flows at the higher rate. Then what we do is minus the cash flows. Okay, this is at lower rate minus cash flows at higher rate multiplied by higher minus lower rate. This is the formula for IRR. This can also be asked in the examination, what is the formula, then you can do this point, right? That is, discount rate is not given. A firm has an inventory turnover of 3, the cost of goods sold is given. Okay, now the question says ITR is equal to COGS upon average stock. So the ITR is equal to COGS. The COGS is given as 2,70,000 now. Okay, it's basically 3 is equal to COGS is 2,70,000, while we have average stock which is not known to us. So what would be the average stock? It would be 2,70,000 divided by 3. That is, average stock is equal to rupees 90,000. Then with better inventory management, the inventory turnover is increased to 5. We can increase our inventory turnover to 5. Then what can we do? If the inventory turnover is increased to 5, then it would be 5. This would result in, then what would happen? Your 2,72,000 rupees is there. Then what would be your average inventory? It would be 2,70,000 divided by 5, giving us a value of 54,000. There would be an increase. Okay. So what's happening in this case is, in both the cases, find out the average stock first. So in the first case as well, then the second case as well. In the second case, the value comes out to be 54,000. When ITR of 3 is taken, then what is the average stock? ITR of 3 is taken, then average stock is calculated. Then when ITR of 5 is taken, then the average is also calculated. This question can be converted into 3 parts as well. First is, when we have ITR as 3, what is the average stock? When we have ITR as 5, what is the average stock? And what is the difference? See, the average stock will fall to 54,000. The question is asking that what is the increase or decrease. So basically it is a decrease. Out of, earlier it was 90,000 now. From 90,000 deduct 54,000. The value comes out to be 36,000. 36,000 is a decrease in the value of the inventory. The correct answer would be B. Right? Okay. Now comes the next question. This is regarding shares, everyone. It says X Limited forfeited 40 shares of rupees 10 each. Then on which 4 per share were paid. Whatever amount is normally paid by the people is forfeited. Forfeiture means any amount which that particular shareholder would have paid, and this is the amount they have paid. We are basically, what are we doing? We are making sure that the amount that they have paid till now, we are not giving them back, because we have asked them so many times to pay but they didn't. So if the forfeited shares are reissued as 8 per share paid up, what is the minimum price that the company must charge? Is it 4 per share, 8 per share, 10 per share, or 2 per share? What would be the value? Okay. See, the point is, if the forfeited shares are issued at 8 shares paid up. See, the point is that we can give a discount of 4 rupees max. Whatever we received from the previous shareholder can be given as a discount to the next shareholder. That's why we have already received 4 now. What to do? In this case, they said rupees 8 per share paid up. That means from the next person, we are asking them to pay a. The total value of the share would be 8. For them, the value would be 8 rupees. Out of that, how much discount can we give to them? See, the point is, if we have received out of 8, we have already received 4 from the previous person now. So 8 minus 4, it would be 4. So that means we have already received 4 from the previous person. So the discount that we can give to the next person would be of 4 rupees. That would be rupees 4 per share. Okay, here comes the next question. The next question says, regarding the list 1 and list 2 is given, and you have to find the correct answer. List 1 is accounting for fixed assets AS3, disclosure for accounting policies AS10, leases, and it's accounting in AS19, cash flow statement. What would be the correct answer in this question? Would it be A, B, C, or D? Let's look forward to it. AS19 is third point. Is there anything that would say that D is 3? Okay, there comes the point. AS1 is disclosure of accounting policies. We need to disclose everything in terms of the accounting standards that we are using. That is true. Then in terms of B, that is AS3. AS3 is cash flow statement. That is also true. Then C, that is AS10 is accounting for fixed assets. This can also be written as PPE, property, plant and equipment. Recently the name of this particular accounting standard is yet to be changed. It's there but not yet changed. So this can be asked in the examination from the point of view of the latest things. If they are trying to cover, only then this can be asked. Otherwise they'll give you PPE or accounting for fixed assets. Right? The correct answer would be this. Okay, the currency swap is a method of hedging against foreign exchange risk. then speculating is a foreign exchange, then a leverage instrument used by cooperative banks, or mode of payment in international trade. Currency swap is a method of when we are taking when this is basically done when we are too scared about any currency that can lead to a failure. So what we do is we purchase a particular currency in order to sell it in the future. So basically we are scared about we can lose money because of the change in the price of the currency. So correct answer would be A, that is hedging against the foreign exchange risk. Okay, this question is regarding the bills of exchange, everyone. The question says, who are the parties to a check? Drawer, payee, acceptor, or holder. A negotiable instrument there. Who are the parties to a check? Choose the correct answer from the following: A and B, A, B and D, A and C, or all of these. It would be A, B, and D. Right, the correct answer would be B. The drawer, the person who says in the name of that particular person, if it is given to someone and it's a bearer check, then the holder can be the one, and the one on whose name is written, that is the payee. That would be A, B, and D. Okay, here comes the next question, everyone. It says an inflation rate of 10% and expected nominal cash flows of 22 lakh, and the value of the real cash flows would be 19 lakh 80, 10 lakh, 20 lakh, and 24 lakh 20,000. What would be the answer there? It would be 22 lakhs divided by that would be 100 plus the percentage of inflation. So it is 22 lakhs divided by 110. It is 22 lakhs divided by 110. In terms of percentage, the value will come out to be 20 lakh. The nominal or the real cash flows is 20 lakhs. That means before the adjustment it would have been 20 lakhs. Okay, here comes the next question, everyone. The nature of a suspense account will be debit or credit balance, credit balance, or none of the above options. When we talk about the nature of a suspense account, it is unknown to us. We do not know what's going to happen in terms of the suspense account. So it would be treated as either it can have a debit balance or a credit balance. Any of these two can be there. So it would be debit or a credit balance. Okay, here comes the next question regarding conservatism. The concept of conservatism. Concept of conservatism when applied to the business, the balance sheet results in. Conservatism is anticipate the losses but not profits. So when we talk about this, the concept of conservatism when applied to the balance sheet results in understatement, overstatement of assets, under overstatement of capital, or none of the above. In terms of concept of conservatism when applied to the business, it would be treated as when we are anticipating the losses but not profits. That means we are not recording our assets at as per their correct value. That means there is an understatement of assets. We will not record the assets at their true value, but we will record at a value which is lesser than the one, because we are trying to anticipate the losses. Accounting for conservatism is a principle that requires a company accounts to be prepared with caution, and high degrees of verification is required. All probable losses are recorded when they are discovered, while the gains can only be registered when they are fully realized. Till the time we do not receive the money, we will not record it in the books of accounts. Right? Okay. Moving on to the next question, they have given you the list price of the goods purchased is 60,000, cash paid is 40,000. Okay, let's look forward to that. The list price is given, LP is this. From LP we have the trade discount, whatever we are left is our purchase price, then we have the cash discount, and then we have the price that we pay. So we are paying 45,000 after receiving a cash discount of 9,000. I received a cash discount of 9,000. What am I going to do? 45,000 plus 9,000. I'm going to get that particular amount of 54,000. So what's the difference between 6? This would be 6,000. So 6,000 divided by 60,000 will give me the percentage of 10%. What have I done? Let's discuss it again. I knew that in this question, whatever they have given, first one was the list price was 60,000. The cash discount was of 9,000. They have already given, and the amount of 45,000 was already given. So I just added these two, got this amount of 54, and now I'll find the difference between the two, 60 and 54. That would be 6,000. And since the trade discount is always on the list price, so it is 6,000 that I have taken. 6,000 rupees divided by 60,000 rupees, right? That would be the amount. In the examination, I still think that in terms of ratios, there would be a question regarding the current assets, working capital, ITR, the turnover ratio, solvency, and the liquid ratios. These three have more chances of coming in the examination. Along with that, in terms of capital budgeting, at least one question can be there from the theoretical as well as from the practical area of both these questions. NPV, theoretical as well as practical question can be there. In terms of bond valuation, kindly do it very properly. There can be questions from the bond valuations in terms of YTM, right? So that can also be there. Okay, before actually moving forward, let's talk about the bond valuation as well now. In terms of bond valuation, what do? We have a coupon rate, that is the interest rate that is given. Whatever rate is given, use it to calculate that interest, but that interest is going to be received for interest for the first year, plus interest for the second year, then interest for the third year. We are receiving the interest for say 3 years. So whatever the yield to maturity, they'll give it the expected rate of return or the YTM. Then take your YTM rate here and the number of years, say 3 years here. Then whatever the value of that asset would be. See, by if I take a loan, I took a loan of, okay, let's calculate this question using, I'm going to explain this point using an example. Look at this. Here it is. I'll come back to the question, don't worry. If in the question says that you have to calculate the YTM, you are given a particular, you're given a question where the face value of the bond is rupees 1,000, right? The face value of the bond is rupees 1,000, and the face value is given, and the rate would be 10%. The coupon rate is 10%. So it is basically 10%. That means 100 rupees is the rate of interest for 3 years. And my expected rate of return is 11%. If I expected more than that, then what will I do? It would be 100 rupees is going to be received for 3 years constantly now. So 11% discount rate for 3 years, add it up. But by the end of the third year, what will happen? By the end of the third year, I will also receive my amount back now. This is my interest and this is my amount. So this amount would be added, and that would be 11% for the third year only, nothing else, but only the value for the third year would be taken here. So how do we calculate it? It's going to be 100 multiplied by 1 divided by 1.11. 11% is taken now. So the values would be would be 2.443. This kind of question can be asked in the examination. This is a very interesting question to look forward to, especially from the point of view of case study. Easy, yet something that requires a little time. Then whatever you had taken towards the value of the third year, that would be 1 divided by 1.11. Then okay, let me calculate it for you. What would be the value for the third year? So this can be easier for you to understand. I'm taking my calculator here. Okay, I hope it's visible right now. right? Coming back to the area of this, I'm sorry, this is basically the mirror image thing. 1, I'm then coming towards 1 divided by 1.11. Since the rate of interest is 11% in this case now, it's 1.11. Now clicking onto the area of equal to. First year it was 0.909, second year it was 0.8116, for the third year it is 7311, and I can total it up. I can either put it in the memory in this calci. I also have GT function, so I just totaled it. So this was the point. But for the third year, what was the value? It was 0.731. So what am I going to take up? It would be 0.731. So it would be 1000 multiplied by 2.443, giving us a value of 244 2.443 multiplied by 100. It is 2.244.3 plus 1000 multiplied by 0.731, giving us a value of 731 rupees, plus 244.3, giving us a value of 975.3. The question can also arise, what is the change in the value? See, the earlier the value of the bond was 1000, now it is at 975. That means the value has basically declined. 1000 minus 975, 975.3. This is at rupees 24.7, less than the face value. This particular part is called, this is at a discount. When the value of the bond in future is going to increase, it's called at premium. When the value is going to decrease, it's called discount. At this point of time, it is a discount. This is one of the concepts that you should remember in terms of your examination, and sometimes in the question they will not even give you YTM. This can also be there. You will have to calculate the YTM. The method for calculation of YTM would be YTM would be when you have to calculate approximately, then it would be whatever your interest rate is plus your face value minus your redemption value, whatever redemption value is, divided by the life of that particular bond, and here face value plus the redemption value divided by 2. Average of those is taken, and here face value minus the redemption value divided by the life of that bond is taken. This is also called cost of debt, KD, or this is how you calculate your YTM if the YTM is not given in the question at all. So in this case, all the formulas for YTM, I have done it. This is what you can do. Kindly review these formulas for your examination properly, because these can be asked in the form of formulas, or it can also be asked in terms of a question. Okay. Now, if $1 is rupees 70.8450.545. This is another question from what? This is Forex. Now the question says the rates in London market are $1 is euro 0.9027. What is the price? How do we calculate? It is the same, so let's divide it. Since the LHS is same, everyone, it is same. It's going to be 70.8450 divided by 0.9027. It would be equal to, okay, it would be equal to 78.48. That is the point that I am getting, right? So see, always take up the selling rate. Always take the selling rate. Never take the buying rate. It is basically 70.8545. That is what I'm going to take. I'm not going to pay any heed or attention towards 8.8450. Why? Because if I buy dollars, I'll also sell dollars as well. Now I'm not going to keep the dollars with me, so I'm going to sell the dollars and then I'll be moving forward. So it is 9027 divided, that it is 78.49 only. It is 78.49. If we divide, it would be the value 78.49. Right? So we have done with YTM. We are done with almost all the areas in a deeper way. So I hope you'll be able to do it in a proper way in the examination as well. all you can do is, especially this is the area towards the shares, it says according to section 52 of the Companies Act 2013, the security premium cannot be used for the purposes. See, security premium is something which is used for a specific purpose only. It is not used for a random thing. It is used for only for a specific purpose. They are the specific reserves, not general reserves. When we talk about a specific reserve, it is used for the issue of fully paid bonus shares, or for meeting the preliminary expenses incurred, for meeting the expenses and commission or discount incurred concerning securities previously issued by the company, or for repayment of a long term loan. Now, according to section 52, it can be used for multiple areas. It can be used for issuing bonus shares for preliminary, but it can never be used for any repayment of loan. That is not there. It can be used on or for other purposes. There are 5 various purposes for which it can be used: for issue of fully paid bonus shares, for meeting the preliminary expenses, for expenses commission discount which were there in the organization, we are writing them off, write it off from here only, for ensuring the availability of premium on redemption of redeemable debentures, it is there for funding the scheme or buyback of securities. Then it is basically for all these purposes it is used. So the answer is D. Okay, now the next question is, in case of the cash replenishments at ATMs, reconciliation of the transaction shall be done between bank, service provider and its contractors, at least on dash basis. It is done on T plus 3 basis. It is done on T transaction day plus 3 days. This is T plus 3. Acha, spot transactions are also, there is one more thing that I just got to know. I just remembered it, so I'm just telling it to you. Spot transactions are are completed by the time of 2 days maximum. So from this we have got 2-3 more types of transactions there. If it is settled today only, it is called TOD. If it is settled tomorrow, it's called TOM. And if it's settled 2 days, within 2 days of the transaction, T plus 2 days, then it is spot. If it is more than 2, then we call it futures. So this is the entire forex, whatever portion of the forex was left, we are done with that part as well. This is the crux of the entire forex there. We have done with the chain rule, we are done with this. I've told you about the bid and ask rate. Always remember that the higher rate is ask rate. We buy low, we sell high. That is the formula that we're going to use. Here comes the next question, everyone. Dash vouchers denotes payments of the cash. Cash payment, cash receipt, bank payment, or all of the above. When we talk about the vouchers which talk about cash, cash payment talks about cash. Be it receiving or paying, all these transactions include movement of cash. So all of the above. Acha, these are all cash vouchers. I'm sorry, I was thinking about cash vouchers. These are all cash vouchers. But the point is, for the payment there is only cash payment. For payment of cash, it's only cash payment. For cash voucher, all those are vouchers, but not for the payment. For payment, it's only the cash payment there. Acha, next question says, the person to whom the bill is endorsed is known as. If I endorse a bill in your name, who will be you? I'll be the endorser, you will be the endorsee. Right? In terms of the person to whom the, see, if I'm the drawer, I drew a bill in your name. I said, I order you to pay me certain amount of money after certain period of time. You are the drawee. And remember, there is, in this transaction, we have 3 days grace period as well. The questions can be asked regarding the grace period as well. So always remember, whatever your due date is, just add 3 more days. Just being sure that in case you have these kind of questions in the examination, you are able to do it, right? It would be due date plus 3 days. So now, if you are the drawer and if you give the money to me only, you are the one who's paying, you are the payer, and I am the payee. And what if I give your bills receivable to someone else? If I give it to someone else, then you will be paying on my order. So the payer can be bank, it can be any of my creditors, whosoever is holding that particular bill. They become the the person who's holding it. They can be the endorsee. Acha, sometimes what I can do is I can sell this bills receivable to the bank as well. If it is sold to the bank will never give me the full amount. It says, even I'm going to keep my commission. Na? I'm going to keep that bill for that particular time. So this is called bill discounting. the amount which the bank deducts in the name of interest. That's called bill discounting. Along with this, there is one more thing. If the bill discounted is dishonored, if it is dishonored, then it would be treated as then if the bill is dishonored, whosoever is holding the bill has to pay noting charges. They pay an amount called noting charges. They are supposed to pay it, only then they can get it. There can be a question regarding one more area. I remember it at this point of time, so I'm just telling it to you just to be, just being safe there. Accommodating bills. These bills are actually kind of fake bills. I don't owe you money, you don't owe me money, but the point is I am in dire need of money and you are also in dire need of money. What I did was we created a bill. That Niharika Walia has ordered you to pay 10,000 rupees. Now you accepted the bill and I have got the bill of rupees 10,000 that I will receive 10,000 from Mr. B after 2 months. Now I went to the bank and from the bank I got it discounted. I have got 10,000, both of us will split that money, we'll use it for 2 months. After 2 months, both of us will collect the money and pay it to the bank. There was no asset there. We just created an asset so that we can get some money from the bank, as we do not have any collateral as well. So we are just stuck there. So we got that amount from the bank. These are called accommodating bills. We are trying to help each other. That is what we call these kind of bills. Okay, here comes the next question, everyone. The bad debts recovered rupees 1,000. It will be credited to the bad debt, credited to the debtor personal, credited to the creditor personal, or credited to the bad debts recovered. Whenever we recover a bad debt, what does it mean? We are recovering it from an old debtor. It's a time barred debt. We cannot receive any money after a certain period of time. The bank has discharged this person. He's done with it. He just came back and said that I've got my money. Can I give you back it to you? I said, okay, give it back to me. But the point is, the debtor has been deducted from my books of accounts long back. He's eliminated. His name isn't there. So what will we do? Whatever amount we that particular person owes to us would be treated as an income. It's a bad debt recovered. Do not record its personal name. The person is gone. He was removed from our books long back. So the correct answer would be D. Bad debts recovered. A question from journal. A special journal, I would say. Okay, here comes the next question, everyone. Capital profits arises from which of the following? Profit prior to incorporation, premium received on issue of shares, profits made on reissue of forfeited, or all of the above. Capital profits means when you are eliminating any asset, or if you are extinguishing or selling any asset, or you are paying off a liability at a lower amount. So what will that particular profit be? In terms of capital profit, all these three are capital profit. You are making a profit, but other than from your regular business. So it's all of the above. Okay, here comes the next question, everyone. I think just a little adjustment is required. Okay, here comes the next question. Which of the following is not a feature of trial balance? It is a list of debit and credit balances which are extracted from the ledgers. It is not, does not prove the arithmetical accuracy. It is not an account, it's a statement, and all transactions are primarily recorded in the books of accounts, hence called a primary book of entry. Okay, remember, trial balance and balance sheet, they are statements. They cannot be defined as accounts. So real personal nominal doesn't go with any of these accounts. Number two, this is just done to arithmetical accuracy. This is a summary, and you know there are books that really states that account trial balance is not even a part of accounting balance, the accounting cycle. It's just a mere working paper which is required. So basically, it is what it is. It is not an account. Okay, this is also true. This is also true. It proves the arithmetical accuracy. That's the only thing a trial balance does, and this is the point which they state that it does not prove. It proves rather. So there's only one wrong point, that is B. It does not prove. अच्छा ठीक है ठीक है ठीक है नहीं, that's also correct. हाँ, sorry, that is also correct. It does not prove. Actually, it proves the arithmetical accuracy, but other than that, there cannot be anything else it can prove. So it is basically, it does not prove arithmetical accuracy, which cannot be which can be determined by the audit. Anything which can be determined by audit, that is something which it cannot prove. It just doesn't give a conclusive proof. So the statement is also correct. The last one is wrong, that all transactions are primarily recorded in the books of accounts. This is basically a particular line from cash book. Cash book is basically both a subsea as well as a primary book, because without noting down things in it we cannot do anything, and at the same time it is a part of subsea books as well, but it's also very very important. Money is what everybody has been working for, so it would be treated as a primary expense as well, right? So it's a primary book of entry as well. Okay, depreciation is what? It's a process of apportionment, valuation, allocation, or none of the above. Basically an allocation. What do? We know that the life of the asset is going to be long, so we are going to allocate the depreciation over different years. So it would be C. Next question, everyone. Purchase of laptop. I bought a laptop for office use, wrongly debited to the purchases account. Imagine we have taken an asset into our goods. So what is it? It is going to impact our profit and loss account. This is an error of principle. Error of omission means we forget about it. That is error of principle. We forget those particular things altogether. Error of commission, the amount is wrong, or maybe 100 rupees noted as 1000. Ram recorded as Ram. Sham recorded as SH. See, there are 2-3 names now. It is Sham and Sham. We had no clue which particular account, so I recorded in the wrong account. There is error of commission. Principle is the error which says asset is recorded as an expense. How could you do this? Did you forget the rules of accounting? So when these point of things are coming, that is error of principle. So in case the depreciation is not recorded properly, that is also part of error of principle. Always remember, you not record as commission or any other thing. The rule of depreciation is not applied properly. That is error of principle. It's basically a crime that we are committing in terms of recording the books of accounts. Huh? That's error of principle. Okay. Now the next question. Sequence the following in the CAIIB process. A cash flow estimation, then identification of discounting rate, project selection decision, or determination of NPV. What do? See, first of all, whatever inflow or outflow we are doing, we'll record that. That is A. Then the next point is identifying the discount rate. Whatever discount rate, P factor we are using, that would be taken. Then we will determine the NPV. Okay, one more point. If NPV is positive, accept it. If the NPV is negative, then reject the project. If the NPV is equal to 0, at this point of time the IRR can be, there is a discounting rate which is equal to IRR. Along with this is indifferent point. This is indifference. Whatever we take that particular opportunity or not, it's all the same. That would be the point. It would be A, B, D and C. Okay, this is where I end my particular session, and all the very best everyone. Be calm in your examination, because as a student, even I was always has anxiety, so I always tell everybody that you shouldn't be facing the same trouble. Whenever you face it, there are certain things which I always believe in. Number one is, before going for the examination, correct yourself. Tell yourself that you'll be able to do it. Number two, whenever you are going for the examination, whatever formulas you're going through, at least 10-15 minutes before examination you need to stop. At least half an hour you really stop and just revise everything, and give yourself proper sleep. This is one of the basic areas where you can hinder your brain's working. So it shouldn't be like you are not sleeping at all. Give yourself a little sleep if possible, because I understand everybody had been working, so this is the opportunity where you can give yourself a better time in terms of studies. But a proper sleep is required before the examination, so you do not get any kind of confusing scenarios in your examination, right? So one of those things are that. Along with this, in your examination, always carry a working calculator, and when we talk about a calculator, you should have a particular quick hand over that, as that particular calculator. It shouldn't be like you are still looking in the examination, where is P, where is the percentage, where is the root. No, that shouldn't be done. Just keep an eye on your calculator, and if there's any question where you feel I'm not able to get the answer, leave that question, move on. Do not get stuck over a particular question. Give a respective amount of time, but after that, leave it. It doesn't matter. The other questions can also be better. Go with the volume there. If you can attempt more number of questions, and that too correctly, then give more importance to them. If there's any practical question, then that means that is going to take more time. Leave it for the time being, finish off the other questions, and then come back to that question. And look, what I normally believe is just get a quick look of the entire paper. I know some people believe that why, how can we do that, it becomes very difficult in the beginning only, why should we do it? You should. It is important that you have an aerial view of what exactly the paper is about. So whatever you can do quickly, you do it quickly, and then go back to those areas which you find difficult. This particular method is really helpful in the examination, because if you get an aerial view of the paper in advance, then you know what is easier for me to attempt that part first, and then take the risk and whatever you feel to look forward to. So it's always give an aerial view and then do it, because you know where to start from, right? But it shouldn't happen that by the end of the examination you're still looking that I could do these questions, why was I not able to do it? That's because you were not paying attention to the entire paper. So do these things very carefully in the examination, and be calm, composed when you are doing the questions, and all the very best. Give your best shot, because I know this is very important for all of you. So give the respect that it requires. That is, go in, fight for your examination. You have all the weapons that are required for this particular war you are going to face, right? So your knowledge and your calculator, the two tools that are required, just carry them along in the examination center and in your examination, and give the best shot, right? Thank you so much, everyone. If you're looking forward to anything for JAIIB or CAIIB modules or courses, for further information, you can use the code Y541 and you can get up to the discount of 80%, especially even today it is there at 80%. So if you're looking forward to that, that is there. And both for JAIIB and CAIIB, you can look forward to it. And I hope to see many of you, the JAIIB bankers, in terms of the CAIIB classes as well. So all the very best, and give the best shot. Thank you.